Good morning, everybody. This is Michelle with From 9 to Thrive, and welcome back to another edition of Workshop Wednesday. Today, we are talking all about what is sales of product income and why does that matter to your business. If you've not had a chance to check out from9tothrive.com, head over there. There are a lot, is a ton, is much, so much information over there that will help you escape your 9 to 5 and help you with the information that you have to have in hand to make sure that you are getting set up right, your foundation. And that's what these Workshop Wednesdays are all about, is establishing that foundation and helping us learn something new and something that we can then implement and put into our business. And if you are needing more information, you can schedule a coaching session with me. So over at From 9 to Thrive, go check that out. In the meantime, let's dive into this workshop. So today, we're going to ask, what type of products do you sell? Do you sell physical, digital, or both? This workshop applies mostly to those people who sell actual products, not necessarily services. But we're going to talk about what is sales of product income. Why does this matter? Why is this crucial? And why does this matter to your business success? What are some financial metrics and how do they affect your profits and how should you track those? And some best practices to increase your revenue and avoid some common mistakes. So let's dive right in. What is sales of product income? The definition is simply, it's the sales of product income refers to the total revenue earned from selling tangible or digital products before deducting expenses. So that's it. That's your product. That is your product income. You sell either a physical product or a digital product, and the money that you make off of each of those sales, that is your product income. This is different from a service-based income, such as consulting, coaching, and freelancing like I do. This is the number when your accountant or you put into your financial spreadsheet or you use your financial software. That is that top number that you're going to see on your income statement. That's considered top line revenue. When somebody asks you, what's your top line revenue? That's it. That's purely, I sold 100 of these at this much money, and that's that number. This number is going to include physical products and digital products. So if you sell clothing or jewelry or handmade goods or retail sales, or you sell ebooks or online courses, things like that, that is what's going to go there. Let's do an example. If you sell 100 candles at $25 each, your total sales revenue is going to be $2,500. And that's that top line. We haven't subtracted off any expenses like materials, your packaging, your shipping, or any of that. That is strictly your top line number. Why is this important in understanding what this number is and why is this crucial to your business? Number one, it's your starting point of your business. It's that top line number, that top line revenue. That's the foundation of all of your financial statements. When you go talk to a bank or you're sitting down looking at the financial health of your business, that's where we're going to start. You sold 100 candles at $25 and you have $2,500 in revenue. It also helps you determine whether or not you are growing or are you struggling. Where am I missing it? What products are doing well? Which ones aren't doing well? Number two, this affects your profitability. If revenue, so that $2,500 from selling that 100 candles, doesn't also always mean that you're making a profit, because from that, you have to subtract out your cost of goods sold, which basically is how much did it cost you to make that candle. In that candle, you have your wax, your wick, your glass that it's in. So you need to subtract all of that off. And that then gives you had $2,500 because you sold 100 candles. It cost you $500 to make those candles. So now you have a gross profit of $2,000. And then you have all these other expenses that your marketing, your rental of your business, your utilities, the shipping, the packaging, all of that, that comes down, your taxes, your insurances, all those little funny things that we have to track get subtracted off of that gross profit number, that $2,000, and that becomes your net profit. That's actually how much money you make. And this helps you understand how much does it cost you to actually sell a product? What is your cost of sales? And it helps you determine what is the right sales price for that candle. Is $25 too low? Because I have all these other expenses that I need to cover, and am I ever going to make money? It's a really nice exercise to go through to figure out if I am pricing my products correctly. Number 3, it drives business growth and cash flow. A steady revenue stream means you can reinvest into marketing and new products and scaling up your business. It also helps you to determine if you need third-party funding, such as loans, or however you're going to do that. Do you need more money to scale? But don't get caught in that trap of constantly going into debt and getting more money that you're never going to be able to repay, because that top line number is never going to generate enough to cover everything else that happens. And number 4, like I just alluded to, it helps with financial analysis and strategic decisions. What products are making you the most money? Which ones are flying out and you can sell consistently all the time? Should you expand on those products and create similar ones? Do you need to raise your prices because they're not covering your expenses? Or are these really slow, sluggish sales and you just need to discontinue them? This is where you're going to start doing those analytics. You're going to understand consumer demand and what do you need to do to boost sales? And if I boost sales and increase marketing, is that really going to help? These are the numbers. You need to know these numbers to be able to decide, what am I going to do? And is my business moving forward, or am I struggling? Let's break down these must-know financial metrics. Understanding these key terms helps you make smarter, better business decisions. Number 1, total revenue versus net revenue. I alluded to this before. So total revenue is your gross sales, the total amount of money that you made selling those candles before any deductions. 100 candles, $25. Your total revenue was $2,500. Net revenue is what's left after you have your returns and discounts and allowances. Let's walk through this. Let's say you sold $10,000 in products. $500 came back in refunds, and you had $300 in discounts, which is net revenue. So we subtracted out, we took the 10 in your sales, we subtracted off the 500, we subtracted off the $300 in discounts. So now we have a net revenue of $8,700. See how that starts to subtract off, and just because that top line number is large, you got to make sure you're taking into account any refunds and discounts and sales that you're running that affected that product. Let's talk about the differences now between cost of goods sold and the cost of sales. If you're working with somebody like me that's in venture, I'm going to ask you what's your cost of goods and your cost of sales. How much does it cost you to manufacture that product? What's the direct cost? That includes your materials, your labor, your packaging. How much does it cost to make that candle? Versus the cost of sales. The cost of sales is how much does it cost you to make that candle, plus how much does it cost you to market it, store it, and distribute it? So that's your shipping, your storage, and your marketing. That's the cost of sales. So let's go through that example. Let's say you're selling handmade candles for $25 each. Your materials and your labor per candle are $10. So your cost of goods per candle is $10. Your gross profit per unit, so you're going to take that $25 that you sell it for, and you're going to subtract off the $10 for those materials and labor. So your gross profit per candle is $15. See how that works? Now let's take it one step further. You have gross profit versus net profit. We talked about this a little bit earlier, but gross profit is that total revenue, that top line, that first number, less how much it cost you to make that product. That candle example, it was $10. Your net profit is your total revenue less the cost it cost you to manufacture that product, less your operating expenses, less your taxes. So let's talk about operating expenses. That can be rent, salaries, marketing, administrative expenses. And I know that was a lot, so let's walk through an example. Let's say you made $10,000 in sales, but you spent $3,000 on materials and $2,000 on marketing. Your gross profit is $7,000 because you take that $10,000 in sales less the $3,000 in materials or your cost of goods. So that gives you a gross profit of $7,000. And then you had $2,000 you spent on marketing. So you take that $7,000 less the $2,000 of marketing. So your net profit is now $5,000. Another thing that you're going to have to take into account for is sales tax, use tax, and anything else that's mandated by your local municipality or state. So sales tax is charged at the point of sale. And then your use tax applies if you buy or sell products across state lines. And all of this you can figure out from your state on the forms that you fill out. And then if you have any other taxes that are due under your state or municipality or any other governmental agency, you're going to have to figure those in because those become an expense that you're going to have to account for on all of your sales. And here's one of the ones that gets everybody all the time. If you look at that first top line number, so we sold the $10,000 and then we had $7,000 in revenue, so because we only had $3,000 in expenses. So our gross revenue was $7,000. If I start looking at this, people think I'm making money because they're not taking into account all the other expenses that they have to subtract off. You want to make sure your margins on that top line, so you take that your total revenue less your cost of goods sold, and you figure out, okay, what are my margins there? How much money am I keeping after I actually manufacture the product? That's going to be one margin. And then you're going to look at what's the relationship between, so that's the margin is the relationship between how much I take in and how much it costs me to make it. And you want that number to be pretty high because then after you subtract off all those other expenses, you would come down with another margin, which is your net margin. And you're going to want to make sure that you have a margin that is in line with your industry because all these industries have totally different margins. And so you want to make sure that you're making money that is comparable to everybody else in your space. If you're making less, maybe it's because your expenses are too high. Maybe because your cost to manufacture is too high. If you're making way more than everybody else, it's because you've probably figured out how to do it less expensive, but are you sacrificing quality to be able to get those higher numbers? There's a balance, and we always have to figure that out. So you have operating margin versus profit margin. And a lot of times you're going to see people talking all about this. So the operating margin is that net operating income divided by your total revenue. And a higher margin means a more profitable business. And we talked about that. That's just the relationship between how much money are you taking in and how much money does it cost you to then either manufacture or operate your company. So let's talk about some best practices to increase this sales revenue and profitability. Because in the end, we want to be profitable. Even if you only sell a couple products, you want to make sure that you have that profitability in mind. Number one, price your product strategically. You're going to go out there and use that market research. What are your competitors doing? What are your customers willing to pay for it? Use that competitive pricing side. That's how you're going to calculate how much you are going to charge per unit. Your unit price is based on how much is it going to cost, how much can you actually charge for it. And sometimes what you're going to find, and I see this a lot in homemade goods especially, is it's going to cost me this to make it, and make sure you include the time and pay yourself the labor to create that product. But what you're going to find though is once you put on a assumed margin, so let's say it's 50%, it cost me, $10 to manufacture this. But let's go with the candle example. Let's say you want to sell a candle for $25 and you can't make it less than $20. You're not going to be making any money on that. You're just going to be breaking even because it's not going to be worth it. And sometimes when we go through this exercise, we figure out that I just can't make that product at a price that somebody can pay for it or is going to be willing to buy it at. So that number one, it helps you price your product strategically or determine, should I keep the product? Number two, it helps you diversify your revenue streams. When you sell digital products alongside physical products, there isn't a whole lot of cost that goes into a digital product. And once it's made, it can just go on auto. You may also look at, can your product be put into a bundle or a subscription model? This actually helps you increase your average order, and that leads to better profitability. I'm going to say this and over again. You're going to want to market, tell everybody in the world what you're doing. So you're going to leverage, obviously, social media and online sales channels. So promote your product and your service on Instagram, Facebook, use paid advertising, email marketing, set up that email campaigns, and find where your clients are, where your customers are. And that's how you're going to seek them out and put your service and product in front of them. And you're going to want to monitor these sales metrics, number 4, in real time. You're going to track your sales revenue daily, weekly, and monthly. Are they going up? Are they going down? Are they cyclical? Are they in line with what you thought would happen? You're going to use this to measure the health of your business. Are you on track or are you off track? And I always say, whenever at all possible, always look at those operating expenses. Can you cut unnecessary costs? Are you subscribing to services that you sort of need but don't really need? Are you paying a lot of money for underperforming ads? Take a strong look at what money is going out and can you cut those? What are some common mistakes business owners make? And trust me, in my line of work, I see this all the time. So avoid these. These are things you absolutely should avoid. When you're setting your price that your product's going to sell for, they don't consider the cost of goods sold. They have no idea how much it costs them to make that product. Need to know exactly how much does it cost you to make that product. Include your labor if you're making it yourself. If you have, because you're going to eventually probably going to pay somebody to make that because you're going to run out of time. And what are your materials, your time, all of that. Not factoring in sales tax and all those other compliance laws that you have for digital products. Make sure that you are putting in the place the strategy of pricing, number one, but also that you have in place a good practice to make sure that those are being collected, those sales taxes are being collected and then remitted back to the entities that they need those. People get so focused on that total sales revenue, that first number, that top line, and they don't focus on profit margins. When you focus on profit margin, you're focusing on whether or not your business is actually making money. I was just working with a client the other day, and they had a great concept. They had a brick and mortar business and had been around for a while, and they started running these numbers, and they were looking at an expansion in a way to refigure and redo their business. And after they sat down and looked at it, they realized, without going massively bigger, which they just could not afford to do, at the size that they were and what they were making, if it all worked out the way they had planned for the next 2 years, at best, they would break even. Can you imagine working 50 or 60 hours a week and you're barely making any money? You're barely making enough money to grow. You're barely making enough money to live on. And that was a decision that they had to sit down and face as a married couple was, do we keep doing this or do we go back and do something that gives us a little bit more freedom, a little bit more peace of mind, and we look at maybe something else next time because this just isn't worth the time and energy. And I think that's where, when you start focusing in on that profit margin, Is it worth your time and energy on what you're doing? A lot of times people forget to track sales and returns and refunds. That affects that bottom line, that top line, because yeah, you sold 100 candles at $25, but did you have any returned? Did you have to do returns or refunds because you had an unsatisfied customer, or it was broken shipping, or you ran a sale that month and it was 25% off? That makes a big difference on how you start calculating in those numbers. And then the last pitfall or mistake I see people make a lot is not analyzing the different types of revenue to grow strategically. There are different types of revenue. You can, like I said, you could do bundles, you could do subscriptions, you can do digital products that then enhance a physical product. You can do add-ons to your physical products. Trying to figure out the best way to increase that cart amount, that average sales per customer, is going to help with that profit margin. But start to explore and look at all the different ways that you can deliver the best service, the best product to your customers. So what's your biggest takeaway today? Mine is I need to really focus in on that profit margin and figuring out, am I doing what I'm supposed to be doing? Am I spending my time doing the right things? If you found this helpful, I appreciate you. If you'd share this, let other business owners or other people like us trying to escape the 9 to 5 know about us, this channel, and that they should stop in and check in with our tips and strategies every day that we have. And let me know, what other kinds of things are you struggling with, trying to figure out? What does this mean? I had a conversation with somebody and they said, I need to be focusing on this. Let me know what you think else you would like to learn. Meanwhile, I am still Michele at Fun from 9 to Thrive, and I hope that you have had a chance to explore our website, sign up for our newsletter. You'll get all of our tips and strategies as we release them every week. We give all kinds of insights and suggestions. There's lots of tips and strategies over at the website as well. We offer a free mini course. And of course, you have the opportunity to book a coaching session with me, and let's figure out how we can take your business or your idea to that next level. In the meantime, you guys have a great day, and we will talk to you tomorrow.